Greetings. Welcome to week 3 and chapter 2 in our study of accounting. In chapter 1, you were introduced to the environment of accounting. You began to see how basic economic transactions were converted into accounting transactions, and you were introduced to using the accounting equation and how the changes in recording these transactions affected the accounting equation, and how the accounting equation is an algebraic expression, and it's subject to the rules of algebra, and it's to be kept in balance all the time. You had opportunities to use algebra to solve for whatever effect might have happened on one account or another. So with all that in mind coming out of chapter 1, now we move on to chapter 2. And chapter 2 is about accrual accounting. Chapter 1 discussed all cash transactions. So in chapter 1 you had a cash basis business, and you had all cash basis transactions. But the world is not all on a cash basis. And therefore the actual accounting that we use is called accrual accounting. And to accrue events means that you look at the economic events that occurred during the period that were not captured by cash, and you record those in the books. And you record them in the books because as an accountant you realize that those transactions had occurred, and you want to recognize them in the books of the business just like you recognize them in your mind. So now we're going to expand our study beyond cash basis and go to accrual basis accounting. On pages 62 and 63, the authors give you an introduction to accrual accounting and an introduction to this concept of economic transactions, all of the economic transactions, those of cash and those of non-cash, rather than only cash transactions. On page 64 to 72, the textbook gives you examples of the various types of transactions that you're now going to encounter. So we begin to expand your understanding of transactions almost exponentially. You'll know probably twice as many transactions, if not close to 3 times as many transactions, when chapter 2 is over as you knew at the end of chapter 1. Notice I put that in the past tense because we want to take chapter 1 with us, but now we want to move beyond that and have more transactions. Some of the examples and explanations that are there as you read through the chapter are, the first one is accounts receivable. Now, accounts receivable is when a customer buys products and services from you, and they buy them on credit. They do it on account. So there's accounts receivable, short-term obligations, gentlemen's exchange transactions between a buyer and a seller. So the seller says, I will sell you these goods, but you will have to agree to pay me in the next 10 days or 30 days or 90 days. These are generally non-interest bearing, and they generally have a blanket agreement that goes with them, but not an agreement for every individual transaction, because these are to facilitate sales. So we find accounts receivable being introduced to you as the first new asset. It's matched to sales, and accounts receivable go up as you increase your sales. So your sales goes up, your revenue goes up, and your asset, accounts receivable, goes up. The next one we have is salaries. Now, employees are earning salaries every day that they work. So as you hire your employees and have them working for you, every day that they work for you, and actually every hour they work for you even, you have an obligation to pay them. But we don't record all of those transactions. We generally only record them on payday. So at the end of the pay period, we record whatever hours they had worked times their salary rate as salary expense going up, and as cash paid out, cash going down. So the asset cash is reduced, the expense is increased. Those are on opposite sides of the equal sign, so that's the way you want them behaving. But remember that there may be some times when the month or the year ends in the middle of a week, and so you're going to be recognizing some of these salaries at some point as a payable, and we'll get to that later in the chapter. The next transaction that they have for you is advertising. An advertising expense is when you pay for advertising in magazines or on the radio, or around Humboldt right now. We see all these buses that look like roving advertisement boxes for different companies. So that's a form of advertising. So businesses would pay for the advertising expense generally when they sign the agreement to have the advertising, and they might enter into a 12-month advertising agreement and pay only the first month when they sign the contract, and then every month after that they have to send a payment for that advertising. So that's the kind of expense it is. And so you would charge advertising expense, make it go up, and you would pay out cash for the first month and make it go down. Again, you might have to prepay for this. You might have to pay for the whole year in advance or 6 months in advance. And so then you would have some economic effect where you've paid for 6 months in advance, but you've only used the first month. So we'll be addressing that type of nuance within advertising expense also a little bit later. But you need to be introduced to salaries expense. You need to be introduced to all forms of revenues. Revenues are starting to come in now. We can see consulting revenues, we can see rental revenues. So anytime that the company increases its wealth by doing a good or a service for a customer and getting paid or charged for that, then you would have a revenue. And revenues are how the business increases its wealth. So remember, revenues are exchanges between the buyer and the seller, and you are the seller in the business, and the customer is the buyer, and they pay you for those services, or they assign an obligation, a claim that they will pay that later. Adjusting entries then at the end of an accounting cycle begin to say, well, what economic effects happened here beyond cash that I need to recognize at this time? What happened to assets, liabilities, revenues, and expenses that there was a change in those, but I didn't capture that through my cash transactions. So now I have to look at my non-cash transactions and maybe even create all non-cash transactions that represent what actually happened, that depict, faithfully represent what actually happened in the transaction. So at the end of this section of transactions, the authors talk to you about adjusting entries that show the economic effect due to the passage of time, and so now you need to recognize those. On pages 72 to 84 are a series then of 2 accounting cycles, so you can begin to see adjusting entries. Now, I've just talked to you about accounts receivable, salaries, advertising, and revenue as 4 new accounts, 4 new types of transactions that are introduced to you in the first part of this chapter, expanding what you already knew out of chapter 1. There's a summary and the idea of an accounting cycle, that these happen month by month by month, over and over and over again. And we do these transaction cycles continuously throughout the year. Some businesses do them only monthly, some businesses do them every day. It really depends upon the nature of the business and what the business wants to do. No business can go longer than 1 year, whatever that accounting cycle, however you're going to define that year. But we really do not recommend letting all of these transactions build up for a whole year. Most places do them every day and close them out every day and do the adjusting entries at least every month. All right. On page 72 to 84 then, we go on to a second cycle of business events, and these lead then to more accounting transactions. So now in this next what is this, 12 pages, 13 pages, we're going to be expanding the kinds of transactions that you know that would be on those transaction worksheets that you were taught to do in Chapter 1. So first we record events. So they have salaries payable is the first example that they give, where you pay your employees for the hours they've worked. They purchased some supplies so that you'll have a prepaid asset, prepaid supplies, and until you use it, it's an asset. Once you use it, then it becomes an expense, but it's not an expense until it's consumed. If it's available to benefit the future, it's an asset. Once it's consumed and used in the earnings process, then it's an expense. So we purchase some supplies. We go out and buy pens and paper clips and office supplies. We go out and buy production supplies. So we have supplies on hand in the business that we'll need to use to run the business. Then they introduce you to a prepaid event, like a rent or a lease. It happens to be a lease in this chapter. And so you are going to occupy some space, and you sign an agreement for a year or two, and you say, here's maybe first and last month's rent, and then we'll pay you monthly, or here's the first month's rent, and then we'll pay you monthly. So you look at those prepaid events as in a lease, and you say, I will record this for now, but I have to remember that I have this obligation every month that I'm in this building. So every month I'm going to have to record this rental or lease expense. Unearned revenues are revenues that are paid to you in advance, that you haven't done the work and you're going to have to do the work in the future. Common examples are magazine subscriptions, which we pay for a year in advance, and then they promise to mail us 12 magazines. We buy concert tickets, and they agree to have a concert on a certain day, and they have our money, and it's unearned revenues to that performer until the event is completed. We have season tickets to athletic events, so you might buy your season tickets to the Giants or to the Dodgers, and then they have an obligation to play those ball games while they have your money. So that's unearned revenues. It's unearned until they actually do the performance or event, and then they've earned the revenues. We introduce consulting revenues again in this or pick them up again in this section of the chapter. So you're going to want to think about consulting revenues, and accounts receivable are discussed again in this part of the chapter. So we saw accounts receivable.